it's my pleasure to introduce Susan Collins, the President and CEO of the Federal Reserve Bank of Boston. I'll say a little bit about Susan. She very graciously has prepared some remarks that she's going to share with us. That'll take about 15 minutes. Our students at Tuck, as I said to Susan, a required core class taught by Professor Blanchard and Professor Chor right now, Global Economics for Managers. This will be like a final exam for everyone, which will be great on monetary policy. And then we'll have a bit of a conversation with Susan, and we will then have an open conversation. Susan wants to take questions from everyone here. Questions, short, focused questions, not soliloquies, and we'll get through as many of those as we can in the time that permits. I'll point out, this is a great example of the total team effort you hear me talk about at Tuck. Emily Weiss, where's Emily? Emily, raise your hand. This all came about because Emily cold called the office of Susan Collins, and Susan, who's awesome, responded and said, I'd love to come to the Tuck School. And here we are. So Emily, thank you for bringing Susan here. Tuck thrives, great students, great faculty, great staff, great alums, some of whom are zooming in. Susan, I will say a little bit about Susan and turn it over to her. She's the President and CEO of the Federal Reserve Bank of Boston, one of the 12 regional banks in the Federal Reserve System. That's the U.S. Central Bank. In this role, she serves on the Federal Open Market Committee. As our students know, the FOMC is actually the entity that executes and decides on monetary policy for the United States. As such, she's one of the most important policymakers in the United States, not to be jingoistic, and also in the global economy. Prior to leading the Boston Fed, she's been in this role about 2 years, I think. Susan was the provost and executive vice president at the University of Michigan. She had other leadership roles at the University of Michigan. Before that, she'd served as the dean of the Ford School of Public Policy for about 10 years. In terms of her academic training, Susan is an economist. Her undergraduate degree in economics was from Harvard University. She has a PhD from the Massachusetts Institute of Technology in economics. And she's long been an expert in terms of her scholarly work on a lot of issues of the global economy, issues of exchange rates, international trade, impact of different global flows on labor markets. And I will say at a personal level, I don't know if you remember this, Susan, I had been an assistant professor here at Dartmouth. I started here 30 years ago. I had been here what seemed like about 10 minutes. Susan at the time was a professor at Georgetown and also a fellow at the Brookings Institution in Washington. And Susan organized a conference on international trade, investment, and labor markets, and very kindly invited me to that conference. It was one of the first academic things that I went to. So I remember very vividly, not that you probably do, but Susan was immensely gracious. And in addition to just being an accomplished scholar and leader in many ways, she's just a great person. I've had the pleasure of knowing her for a long time. So with that, please join me in offering a warm Tuck welcome to Susan Collins.
So I'll start by saying thank you for that incredibly gracious welcome. I certainly remember that conference, and I remember many wonderful conferences where I had the benefit of the insights and perspectives from your dean, Matthew Slaughter. So just a pleasure to be here. I really appreciate the warm welcome, and so from Emily and the broader team as well. So I'd also like to thank the Center for Business, Government, and Society and Dartmouth for welcoming us and for a great experience so far. I have to say, I always look forward to coming back to campuses. There's a, kind of higher education is in my blood. And so, another reason why I'm so pleased to be here. So I do have some initial remarks. I always start with a disclaimer. My comments today are my own views, not necessarily those of my colleagues on the Federal Reserve Board of Governors or the FOMC, which you just heard a little bit about, the Fed's interest rate setting committee. I was intrigued, I had not known this, that when the Tuck School was founded as the world's first graduate school of management, congratulations, that's quite a milestone, that Dartmouth's then president recognized the need for training commensurate with the larger meaning of business. And that really resonated with me because it overlaps with the spirit of my trip here to New Hampshire and the trips that I take around the Boston Fed's first district, which is most of New England, because our focus is larger than many people realize. It is on fostering a vibrant economy that provides opportunities for everyone to participate, to contribute, and to prosper. And so in preparing for deliberations on monetary policy, on interest rates at the FOMC, I consumed tons of economic data and analysis. Yes, I am a bit of a data geek, and I say that proudly. I also really listen to people throughout the economy, employers, employees, entrepreneurs, people who are struggling for one reason or another to participate in our economy, and also those who are helping to support and advance community economic development. And hearing how people are experiencing the economy, in my view, is really vital to policy making, and it's very meaningful for me and for my team more broadly. Just as an example, this morning visited Hypertherm Associates, which many of you, I suspect, know, to learn about their industrial cutting and shaping business and also their workforce. And then I met with the Vital Communities Corporate Council, which is a group of business leaders working to improve lives for residents of the Upper Valley area. And after this talk, I'll meet with economic and community development practitioners for their perspectives on regional economic challenges and opportunities. And then I'll end the day hosting a business leader roundtable discussion in Concord. And so all of those discussions really do factor into how I deepen my understanding of how the economy works in places where it's not working as well. To say, as I've already mentioned, that our work at the Fed is all about supporting a vibrant, inclusive economy that works for all, not just for some people. And of course, an economy's strength and stability has many dimensions. And so that means that the Fed has a number of roles. And I think that's not well understood. And so I do want to take just a moment to say a bit more about that. Of course, we're entrusted with monetary policy making, in particular setting short-term interest rates that ultimately affect the availability of money and credit for businesses and households. And in this work, we're guided by our dual mandate from Congress, which is stable prices and maximum employment. And so we carefully analyze economic conditions using data, doing research, and as I mentioned, listening to stakeholders. We also do a number of other things. We supervise some of the nation's financial institutions, providing vital back-end infrastructure and services to the financial system and to the US Treasury, ranging from currency and coin circulation. You don't realize when you go to that ATM, the Fed actually had something to do with there being something you can take out. And also, for many years, we've been involved in innovating to make payment systems more efficient. And last July, the Fed launched a new instant payments infrastructure called FedNow that, when fully available, will provide substantial benefits for consumers and for businesses, something that we're excited about seeing become much more engaged throughout our economy. In addition, we examine factors that limit people's participation in the economy, and we support collaborations that expand opportunities. For instance, during my last New Hampshire visit, I explored the economic effects of limited childcare options with providers, consumers, and advocates in Manchester. So in the rest of my remarks, I want to focus on the economy, monetary policy, and my outlook. As a Federal Reserve policymaker, I'm resolutely committed to bringing inflation sustainably back down to our 2% target in a reasonable amount of time. And I remain optimistic. I like to say realistically optimistic that this can be accomplished amid a healthy labor market. And I want to say more about all of that. So along the way, I do want to use some charts to illustrate some key points. That's the academic, miss being that professor a little bit. Figure 1 really is intended to set the stage by showing the history of inflation and unemployment, the two facets of the Fed's dual mandate. And shaded bars here indicate recessions. The left-hand panel shows 12-month PCE inflation, lots of different measures of inflation. And the blue line is total or headline inflation, while the red line, core inflation, excludes the volatile but obviously very important categories of food and energy. But that chart on the left clearly shows the recent surge in inflation after many years of price stability. And to me, that highlights the challenges that high inflation poses for households, for firms, and more generally for our economy. And that's an important part of the why we're so focused on the work that we're doing. While inflation has come down significantly from its peak, it's still elevated, and progress to returning it sustainably to our 2% target will likely continue to be bumpy. You can see that it's not fully smooth, even though this is a 12-month measure which averages over many, many months. Indeed, core inflation, historically a good indicator of future inflation trends, has further to go than total inflation to return to our target. On the right, which shows unemployment, the unemployment rate, that rises during recessions and typically recovers quite gradually. And the pandemic-induced unemployment spike, as you can see, was particularly severe, but the recovery was also remarkably quick. one of the many ways or things that distinguishes this cycle from prior ones. And unemployment has remained below 2% since February 2022, which is historically very low. So with the goal of restoring price stability in a reasonable amount of time, the FOMC began raising the federal funds rate in March 2022, and figure 2 shows that the rise was unusually rapid as well, an increase of 525 basis points in 16 months, with 80% of that increase in the first 9 months, moving the monetary policy stance from highly accommodative to restrictive. The FOMC has maintained the funds rate at the current level of 5.25% to 5.5% since July, and the committee is carefully assessing when it will be appropriate to begin reducing the target range. Despite that higher policy, economic activity has been remarkably resilient. Real GDP growth, which is the blue line that you see here, rebounded quickly and has recently been close to its pre-pandemic rate when interest rates were much lower. GDP growth in 2023 at 3.1% was considerably stronger than most forecasters expected at the end of 2022. The red line in this chart shows household consumption, which accounts for about 2/3 of GDP. This has been a crucial driver of economic growth in the aftermath of the pandemic and has continued to expand at a robust pace recently. Business investment growth, another key component, has also held up despite the fact that credit costs have been higher. In the labor market, continued strong economic activity has translated into that unemployment rate near historic lows, and recent wage growth. Importantly, these positive labor market developments have been associated with unusually equitable recovery, and I just want to talk about that very briefly. The panels in this figure, figure 4, compare the evolution of employment relative to population during this labor market recovery, and that's the blue lines here, with the average for the past 3 recessions, which is the red lines, across different racial and ethnic groups. And what the panels show here is that job loss in the pandemic recession was sudden and sharp, and you'll see that it was more pronounced, and this is typical for Black and Hispanic workers. But it was followed by this very rapid recovery, and this time around, unlike in prior cycles, the employment recovery did not take longer for minority groups. Wage growth, which is not shown, but has also been relatively favorable for lower paying occupations. So while these developments can't be taken for granted, they do represent tangible progress towards achieving a more broad-based and inclusive notion of full employment. One of the reasons for the inflation surge was demand outpacing supply, which put pressure on prices and wages. So the slowdown in inflation in the second half of 2023 in this context of strong growth was really remarkable. Typically, that's not what we see. Indeed, core PCE inflation fell to around 2% over the last 6 months of 2023. Substantial disinflation amid sustained real activity, remarkable, and it points to improvements in supply as having played a really significant role. And those developments can be traced largely to 3 factors: the resolution of supply chain bottlenecks, a rebound in labor force participation by prime age workers, and that was driven in part by immigration, and notably labor productivity gains in some sectors. So far, tight monetary policy has had a limited overall impact on economic activity, and this is likely due to factors specific to this recovery, which have strengthened household and business balance sheets and made demand somewhat less interest sensitive. So again, a number of features of this cycle that are unusual. Given the evolution of economic conditions so far, what can we expect going forward, and what are the implications for the conduct of monetary policy? And here a key, but I would say open question, is how much longer supply side progress might continue to reduce inflationary pressures amid strong economic activity. Figure 5 shows that the prime age labor force participation rate, which I mentioned earlier, is above its pre-pandemic level. That suggests that the potential for more workers to come off the sidelines, while really helpful so far, that may be limited for additional movements in that direction. And productivity is always difficult to forecast. Many businesses, especially in services, have learned to operate with fewer workers, but it's likely that this trend can't continue indefinitely. While it's possible we'll see further reductions in price pressures from the earlier supply improvements, Firms' willingness to pass on additional cost savings is likely to require a slower pace of demand going forward. I believe the current policy stance should deliver that more sustainable rate of growth while preserving a healthy labor market. And in fact, I do see some signs that are consistent with an expected demand moderation. Delinquencies in credit card and auto loans have been rising, and they're at or above pre-pandemic levels. Some consumers are financing expenditures with revolving debt. Excluding aircraft, capital goods orders are slowing, suggesting firms are becoming more interest sensitive. And despite recent hiring strength, there are indicators the labor market is normalizing at healthy levels. But there's considerable uncertainty about when and by how much activity is likely to slow. And the FOMC statement in January acknowledges this uncertainty, saying the committee does not expect it will be appropriate to reduce the target of the federal funds rate until it's gained greater confidence that inflation is moving sustainably towards 2%. So some of the recent data illustrates that need for greater clarity that inflation is sustainably on a path back to 2% before we adjust the policy stance. The January jobs report showed much more hiring than expected, with job gains for December also revised upwards, and revisions have been often a key part of the story as well. And the data we have for price growth in January was also on the high side. So more time is needed to have greater confidence about the outlook. And I want to emphasize greater because I do expect the economy eventually will slow as we see the full effects of past monetary policy actions taking hold. But I also expect that path is going to continue to be bumpy. And that we should not overreact to individual data releases and data readings. We need to take the time and look holistically as we assess the data. And furthermore, I see the risks around the outlook as having come into better balance. So it's essential, first, that we not ease policy too soon to really ensure we restore price stability. But at the same time, waiting too long would run the risk of excessive slowdown. So those risks have come into better balance. So what would I need to see in the data to determine when, in my view, it will be appropriate to begin easing policy? Well, expecting all of the data to speak uniformly, that's too high a bar. But still, it will be important, in my view, to see sustained broadening signs of progress while recognizing that that progress will be uneven. So the higher than expected January CPI inflation numbers I mentioned are just one example of unevenness. This figure shows a measure of the volatility in monthly core inflation. And while moderating, it does remain elevated. So we're still seeing quite a bit of volatility in the data compared to historical averages, which is one of the reasons for taking more time to assess the trajectory. And not reading too much into any one data point. And in terms of inflation, I'll continue to focus and pay attention to its main subcomponents. The three panels in this figure, figure 7, decompose core PCE inflation into core goods, housing, and services excluding housing. And in each of the panels, the blue line is the 12-month measure, and it's the 12-month total measure that we focus on for our 2% target. And the red line shows 3-month annualized averages. And you'll see the 3-month, which has averaged over fewer months, is much more volatile, but it gives us a more recent picture of what's happening. The 12-month is much smoother and really helps to focus on trends and is what our target is based on. But at the same time, it averages data over a much longer time period. And so yet another reason to look at multiple indicators to really get a clear sense of how things are evolving. So while goods inflation has returned to and actually moved below pre-pandemic levels, the other two subcomponents are actually stickier and they're taking longer. So I'll want to see continued declines in housing inflation as well as the non-housing services inflation. Just to be clear, the Fed's target is 2% year over year growth for the total, not individual objectives for subcomponents. But if the effects of supply chain improvements that help to lower core inflation below historic levels, if that wanes, we're going to need to see more in the other components in order for us to be sure that we're on that trajectory. It's also important that short and long-term inflation expectations remain well anchored and that wages evolve in a way that's consistent with price stability. And given the importance of labor market developments for wages and the outlook, I'll continue to look for signs of an orderly moderation in labor demand. So I'm going to end by just saying a bit more about wages, which have been rising faster than inflation. And you can see that in this chart, which shows one measure, the ECI, which is one measure of wages. Recent work by Boston Fed economists, which is available on our website, alleviates some concerns that wage increases might be fueling inflation. The blue line in this figure highlights that prior to the pandemic, wages were growing consistently faster than inflation, the red line, and that gap reflected labor productivity gains. Following the pandemic downturn, wage growth initially lagged price growth, and of course, that had implications for purchasing power for households, despite the fact that productivity continued to improve. Therefore, there's room for wages to continue increasing somewhat faster than the Fed's 2% inflation target plus trend productivity growth without necessarily being inflationary, but to make up for some of the previous productivity gains and price increases. And that's one of the many things that we're watching carefully. And I think there's some good news there for workers as well. I remain, as I said, a realistic optimist in thinking that the economy is on a path back to 2% inflation on a sustained basis with a healthy labor market. The economy is in a good place overall and policies well positioned as policymakers carefully assess the evolving data and outlook. I do want to see more evidence of that sustained trajectory. And consistent with projections from FOMC participants, I do believe it'll be appropriate to begin easing policy later this year. And when that happens, a methodical forward-looking approach to gradually reducing rates should provide the necessary flexibility. So in closing, I want to, again, thank you for having me here today. I've really enjoyed my visit so far. Look forward to discussion. As a longtime educator, it's always a pleasure to be back on campus. There are lots of issues that are so important for students to dig into, no shortage of ways to use your energies and your talents. And so I'm excited about, as I think forward, all of the things that we collectively can accomplish together to really foster a vibrant, inclusive economy. So what we can accomplish when we care, collaborate, study, and act, that's exciting and inspiring to me. So best wishes to each one of you. Thank you. And now I'm happy to join Matthew in a conversation and to hear some of your questions.
Hey.
Out and about in New England.
Out and about, which is great. Yeah, no, so it's a busy day and it keeps getting busy. So thank you for that tour de force overview of your assessment of the economy. I'll start with a question to you in your role in your hat as a Fed president and FOMC member. You described yourself as a realistic optimist. Fairly or not, there are many voices in the world that we read, we hear that would say you and colleagues are more of not realistic optimists, maybe timid piglets. You were too risk averse. You were too slow to recognize rising inflation and start to restrict monetary policy. And now you are too slow to recognize that, as all of our great tech students could say, monetary policy works with long and variable lags, and the time to start cutting interest rates was yesterday. Comment on that?
So lots to say about that. Let me just say a couple of things. One is that I very much appreciate the fact that there are some who are concerned that we may take too long to begin easing rates, and they're concerned that that would imply over tightening and cause more of a slowdown than we really need in order to achieve our goals. And on the other side, that there are people who are concerned that they're seeing, in their view, they're concerned about the other side, and that perhaps we aren't doing enough to ensure that the inflation decline won't stall. And some even are concerned about it moving in the other direction. Again, my baseline is that realistic optimist. I think it is important and valuable to recognize that there's a range of perspectives out there. I see the risks as more balanced and appreciate having discussions with people who share each of those views. The fact that I hear it on both sides, to me, helps to reinforce the view that being really careful and methodical right now, we're well positioned. And we should be taking the time to make sure that we are accomplishing our dual set of goals.
Thank you. Quick follow-up and say as much or as little as you can. Any comment you could share with us about the dynamic among the leadership and decision makings on the FOMC? Because you've got amazing other colleagues there that you work with, and books have been written in history about how central banks do and don't engage at that leadership level. I'm wondering if you want to share about that.
Absolutely, and I will say that my colleagues around the FOMC table are tremendous, and we all work very hard in a variety of different ways. We bring different perspectives, different kinds of data, not just from our districts, which have different industrial mixes, but we also bring our own lens, and we have our own teams that analyze the data. So we're all bringing a lot of background work to that table. And there are other conversations that happen, outside of the FOMC room. We listen hard to each other. I've learned a lot from my colleagues, and that is a very vibrant, substantive, respectful discussion. And there really are a range of views that are expressed. And from my perspective, that's exactly what you want.
Great. Thank you. You talked about, as many colleagues in the Fed, I think rightly do, talking about the desire, given the dual mandate of the Fed, of trying to create a more vibrant and inclusive economy. And you lived in the first district here of the Federal Reserve System for many years over your life, and now you're back here. And as many of us know, live in the Upper Valley, there is a very steep socioeconomic gradient as you move across the 66 counties of our district. So here we are in Hanover, looking across the river to Norwich, Vermont. This is part of, literally and metaphorically, the 1% economy. And the socioeconomic gradient, as you go from here to, think about the New Hampshire, Lebanon, Enfield, Canaan, is pretty dramatic. So I'm wondering how you think about, in your role as president of within the system of the first district in particular, how you and colleagues at the bank are thinking about ways that you can help make our part of the national and global economy more inclusive and more vibrant.
Yeah, happy to say a bit more about that. So a couple of things to say. I take that overarching mission of a vibrant economy that works for everyone, not just for some people, very seriously. So clearly monetary policy, which is what is all over the news, understandably right now, that's a relatively blunt tool that impacts the entire country, actually has global implications, obviously, as well. And one of the reasons that I started my talk by saying a bit more about the breadth of the Fed's portfolio was to make the point that as I think about how do you foster a vibrant, inclusive economy with the focus for us on New England, it's that broader portfolio that helps to complement the monetary policy work that's part of that. And so I can give a few examples. We have extensive research to try to understand particular barriers that prevent people from participating actively in the economy. I think that's essential. There's no way that we can have a vibrant economy, get the kind of growth that benefits all of us, unless everyone has the opportunity to participate. We need the best ideas. We need the energy from everyone. Particularly here in New Hampshire, unemployment rates are super low. Yeah. So how do we find ways to provide pipelines into good jobs across a range of different opportunities and people? And that takes working collaboratively across different sectors. And I really enjoyed the Vital Communities associate discussion that we had earlier this morning, because it really spoke to people coming together, including leaders from Dartmouth and other leaders across the area who have common goals and are working together to find ways to accomplish them. So I think to the kinds of research we do, I think our community economic engagement, I think conversations, I make a point of talking with small business as well as large business, civic leaders, and a variety of different types of stakeholders, and also hearing from participants in the economy who are struggling. One more thing I will say about that is one of the things that was very clear to me, and I knew it from readings and the data, but hearing the toll that high inflation was taking really provided a lot of the why, bringing inflation back down to a low, stable 2% level, in my view, is such a priority. And so it's about understanding the breadth of experiences we have and what does a vibrant, inclusive economy looks like. You can achieve it in a stable environment where people can work together to really address challenges and to try to move forward.
Great, thank you. And a footnote of that, remind or tell everyone in this room, Hannah Payson, who's the executive director for our Center for Business and Government Society, here at Tuck, that center is central in helping build those connections across the Upper Valley to address the kind of issues that you all do for the bank. We have about 20, 30 SECUs each year that serve as board fellows. There's ex officio members on non-for-profit boards in our community that are addressing all the kinds of issues you guys do. Thanks, Hannah. I'll ask you one more if I could, and then we'll open it up to a conversation again of focused questions and then insightful responses. It's actually about your life journey. It's just like, you were an accomplished professor and scholar teacher. You moved into administrative leadership roles, and now you're back in serving the country in a public service role. We talk about our students. One of the aptitudes of wise, decisive leadership we talk about is becoming a lifelong learner. And as a part of that, getting comfortable with how you decide to make changes and ones that bring risk. So I'm wondering if you could say a little bit about your professional journey, and in particular about how you think about taking risks. And we learn from mistakes. We stress that at Tuck. If there's a mistake or a time where you made a choice, you're like, I learned from that in a way I didn't expect. Just a little bit about your career journey above and beyond
There's a lot to say about that. One of the things I will say is over time, taking the time to learn what's important to you, because we're each different, right? I mean, so I did develop a network of people who I would talk to, and often I would get really interesting advice, and I would think that sounds great, but that's not me. And so being able to recognize that. So the things that I realized over time mattered a lot to me. I'll always be an educator at heart. I think taking complicated ideas, issues, trying to understand them, that's part where the lifelong learner comes from. To me, that's inspiring. I get tons of energy. I wake up in the morning and I'm going to get to learn about all kinds of stuff today. That's exciting. I love that. And so the breadth of the portfolio is wonderful. That was true in my academic jobs. It's certainly true now. I struggled with seeing so many, especially young people, but people at different stages in their career, not well supported by institutional structures, and often became a go-to kind of confidant. And so I wanted to be able to help to develop structures that supported people, and created environments that enabled them to thrive, things that maybe I had felt I hadn't had as much growing up. And so that is one of the things that, early in my career, I had a lot of support growing up, which I know is really a wonderful blessing. Was one of the things that led me towards academic administration.
Yeah.
And I found that being involved in a complicated organization where lots of things kind of have to work together, and there's a public mission, that was really inspiring to me. So the why are we doing this work to serve the public? To me, that made a big difference. So a big public university has that. The Federal Reserve absolutely has that. It's a complicated organization with lots of people who are experts and deeply committed to the mission, who have to work together to serve the public, right? It's not for profit. It's it has those different goals. So those have guided me. I will say that some of the hardest decisions to me to make are the ones where you either have a couple of great choices, then do you do this one? They're both great. What do you do? Or you have a couple of really bad choices. So often I would say during the pandemic, there were some really bad choices, and we had to figure out what was the best, even though there was so much uncertainty, we didn't know what was going to happen. I, earlier in my career, loved my job. I was at Georgetown and Brookings teaching, doing research, involved more in applied policy work. My kids were happy. We had lots of family around. My husband really enjoyed his job, and I'd been doing it for a while, and I kind of wanted to do something a bit different. And the opportunity to be dean of the Ford School, totally different, a great opportunity. That was a difficult choice because these are two really good opportunities. Ended up making the decision to move and go more into administration. It was a great decision for me. I'm always extremely thankful to my family who are willing to pick up and move to a new place and, kind of reinvent themselves as well. So I would say the hardest decisions are often the ones where you have choices that are totally different and are either both really good or both not so good.
And coming to the Fed was equally good, not bad, hopefully. Yeah.
Yeah.
Okay.
So from my perspective, that I had moved further away from macroeconomics and economic policy. And so at that stage, I was looking for a way to get more involved in what had been, my career journey, which was much more using my economic background. So that was a great decision. And but I wanted to make sure that I stayed as provost until we were in a better place as a university. So that was a
Yeah.
different kind of
Yes, got
decision. And I have phenomenal colleagues and with a lot of humility, given the impact of what we do, I have to say that was not a challenging decision once I had the opportunity. And it's
Thank you. Okay. Questions from the room? Please raise your hand. Quick focus questions. We'll canvas. We might collect a few along the way here and there with the time that we have. Emily, thank you. We've got microphones. Identify who you are. Quick focus question. You want to do one-on-one initially, or you want to collect a few?
up to you.
All right. We'll collect 2 or 3 questions, and she's going to answer them thematically. Then we'll keep going that way of 2 or 3. Hold the microphone close so we can all hear. Very close.
Period from the Great Recession through to COVID. We kind of, glossed over that because it hit COVID and a lot of changes. But we had such low inflation, we had such low unemployment. Can you talk about some of the lessons that the Fed learned from that period and how you're applying that looking forward as things kind of stabilize post this current cycle?
Yep. So we're going to take a couple,
Yep.
I think. So maybe
Right
right
behind you, and then one more behind you.
Yep. Good question.
Yep. And Ben's going to run them on this
I'm
side.
Rafe, first year MBA student. So rewind to 2019, the Fed was attempting to normalize the size of its balance sheet. COVID happened, the balance sheet and total bank reserves doubled, and now the Fed has officially committed to running an ample reserves regime. Curious how you think about the size of both the balance sheet and total reserves with depository institutions going forward.
One more behind you.
I'm Seamus. I'm a second-year MBA student. So as a monetary policy decision maker, how do you think through, anticipate, react to fiscal policy decisions on the part of the U.S. government?
Okay. So 3 very different questions. At the same time, want to get as many in. So let me start with the last one, in part because as a Fed policymaker, I don't comment on fiscal policy. It is absolutely true that when we look at the economy, fiscal policy influences economic trajectories. And so our models incorporate fiscal policy. And it's certainly something that we pay close attention to and are well aware of. But, I don't make comments on fiscal policy specifically. So, in terms of the balance sheet, so maybe I'll work in reverse order. So balance sheet, and then what did we learn pre-pandemic? So in terms of the balance sheet, yeah, so we are passively behind the scenes working our way through QT, quantitative tightening, as we reduce our balance sheet. Balance sheets, of course, have assets and liabilities. And so we are, over time, looking to get to a place where we have ample reserves. Bank reserves are still highly elevated. And, if you look at the balance sheets, there are multiple components of reserves so far, of assets and liabilities. So far, the reserve part of the balance sheet liabilities has not moved as much as you might have anticipated, given the amount of change overall on the asset side, because other liabilities have moved so much more. We do expect that we'll see more decline in bank reserves, and we'll be really paying attention going forward in terms of what an ample reserve regime looks like, and at what point it might be appropriate to revisit that. But that continues to passively move forward, and we're looking at all of the components and how it's evolving. The period before, so 2019, during that time period, really interesting period. And, it's interesting because labor markets were similarly tight, but with a very different inflation dynamic. We had inflation below 2%, and this is before I was at the Federal Reserve. In this role, I was a director at the Chicago Fed, certainly paying attention and thinking hard about a number of monetary policy challenges. It's really different when you're actually in the seat, though, than when you're, I do think there are things to learn. I think there are things to learn for the current environment. I also think there's some longer term things to learn, because the current environment is still unusual in a lot of dimensions. And so figuring out exactly what translates directly and other things. One of the things that I do think that we learned during that time period is that extensive periods of low stable inflation can create a good context for bringing more people in to participate in the economy in ways that provide opportunity and that really benefit our economy more generally. And I do think that there were lessons in that context that will continue to play a role in how we think more broadly about what role monetary policy can play and how we think about what the risks are that we balance when we consider our dual mandate. So it may be a brief answer to that question, but it's certainly something that there's a lot of thought about and will continue to be.
Hey, we go here and then there for the next trifecta. Let's see. We're going to bring the microphone up here. Thank you, Fiona. Great question. Remind everybody, you got to hold the microphone very close to your mouth so it can be picked up by the audio. It was a question about kind of personal mission and Fed mission. We'll blend.
And private sector.
Very close to your mouth.
Hi, my name is Andrew. I'm a first-year MBA here. My question is on rent inflation. Private indices suggest that rent inflation has been declining faster than some of the metrics that you showed on the presentation. I'm wondering how you weigh the discrepancy between the private and public metrics in making your outlook on inflation.
I love the data focus.
Yeah. There was another hand, I think. Yep, just pass it back quickly. Thank you.
After the 2020,
You are who? Sorry.
oh, sorry, I'm Eric, a first year. After the 2020 COVID stimulus, there was a lot of debate about whether the resulting inflation was transitory or not. And then there were a lot of exogenous inflationary pressures from Russia's invasion of Ukraine. Would be really interested to know what the internal debate was like about whether or not inflation was transitory or not.
Team transitory, rents, mission, all simple.
Okay, there we go. Yeah. So I'll start in the other direction first. So let me start with your question. I'll start by saying the private sector is essential, right? I mean, you don't have a vibrant, inclusive economy without a really engaged, proactive, vibrant private sector, and there are lots of different parts to that. So one of the things that I have been excited about and inspired by is the extent to which the private sector is very often a key partner and player in some of the broader work that we and many others are doing as we think more broadly about the economy. And so in order to address the kinds of challenges that we have across our economy, I think everyone needs to be working together. And so if it is housing, understanding that there are common challenges that the private sector has, that other institutions, whether it's educational institutions, that civic organizations, that individuals, that there are often a lot of shared challenges that people can come together to identify strategies for addressing. And I find that super inspiring. And I think that sharing information about examples, both things that have worked well that people can learn from and things that were tried and maybe didn't go as planned that you can also learn from. I think that's one of the things that I think we can all contribute to, and that is a convener and researcher and nonpartisan kind of resource is one place that can do some of that work. Universities absolutely are as well. And if I think back to my wonderful 10 years at the Ford School, students play a phenomenal role in identifying great examples of things that we can learn from, whether it's things that went really well or things that didn't necessarily, and sharing that information out in a variety of different ways. Sometimes academically, for academic researchers, sometimes for more policy folks, sometimes for business leaders. They're different audiences. And so all of those great writing skills and communication skills come into play as well. So I think there's plenty for all of us to do, and most of the big challenges require us to work together to solve them. So that was a bit of a longer answer. So rents, it's like most things that we are interested in, there are multiple indicators, right? And so what our shelter inflation measure in the PCE, which is the personal consumption expenditures, that is what the Fed is, that is their preferred measure. There's also the CPI, and they are all composed of different components. You're absolutely right that rent inflation has come down more than the data that I showed you. The data that I showed you for shelter price inflation also includes, in particular, an imputed measure of owner occupied. And that has been, I'll say, stickier. One of the reasons we have seen less progress on the overall housing inflation is because of that component. And I think it's too early to tell whether, in fact, that component, that part of the housing market is acting differently, or whether the fact that the sample that we impute that data from is smaller, is suggesting that maybe it's a bit noisier and we're not really extracting the right signal yet. So there are different possible hypotheses you could have. And exactly one of the things we do is we try to look at a number of different indicators. I mean, same thing with research, right? I mean,
Totally.
each research analysis makes different assumptions and different models. From my perspective, if you have lots of approaches that do it differently and all point in the same direction, then I really believe it. But if you have, if you assume this, it suggests that. And if you assume something different, the same thing with data, when the things are all over the place and they're mixed, we're still gathering a more holistic picture. They don't all have to move in exactly the same direction. That's too high a bar. But that's exactly the kind of thing we do. We parse things out and we try to say, what's going on here? How do we understand that? What are some possible hypotheses? Who's studying that, et cetera? So that brings me, last question.
Team transitory, supply shock,
Transitory.
war.
So, yeah. So I was not in this role at that point. I was looking from the outside. Being a director is not, directly part of that policymaking room. I would say that at the time, with the depth of that pandemic recession, and I showed you some of the charts about just how unusual that was. And the unusual dimensions, we had not had episodes with the same kind of supply disruptions, and didn't really have as good, didn't really have as much information about how long that might take to unwind and how to think about that. So I think it's very easy with hindsight to say, maybe people should have recognized X. I think in real time, that a lot of the ways that people were assessing things, first of all, there was a range of views. And, if I put myself in real time with the data people had and the discussions I think they were having, I was not in the room at that time. I think there were a lot of, reasonable conclusions that were made, even if with hindsight, it turned out that inflation surge was much more sustained, larger, more substantial, and needed the Fed to address it than was recognized at the time. So, I think a lot of humility is one of the lessons to take away, that, we know what we know. A lot of our information is based on historical experiences. And when you have a dynamic that's quite different from the history that we've calibrated our models on, being open to a wider range of interpretations, I think, is important. I also think a key takeaway is understanding more fully some of the roles of the supply chain interactions and the timing. So, for example, it wouldn't have been a common data point 5 years ago to have supply indicators. But now that is a standard measure. So we change what data we look at. And I think that that's healthy. I think that that's important. And again, I do think a little humility is essential as we try to assess the data that we have.
Susan was reading my mind. The stridency with which a lot of voices were saying it's team transitory or team permanent was pretty striking. And I think in contrast with a lot of what we learned in and out of the classroom here, right? And at all other great places. I think we have time for one more quick lightning round and then we'll close it out. So I'll look for other hands. Let's see, 1, 2, and 3. And I think that we'll have to close it at that. And you can keep the conversations in class and this afternoon and this evening at downtown.
Hi, I'm Katie. I'm a first year at Tuck. And I'm curious, given your position that is politically insulated and, not supposed to be taking input from policymakers, but you're also having these roundtables about creating an inclusive economy. How do you personally manage that? And what are some of the challenges that you face?
I'm Allie. I'm a first year. I'd love if you could speak to how the Fed thinks about and discusses the US's role in international affairs, specifically because we know US monetary policy has a disproportionate effect on the international economy in other countries.
Hi, I'm Nolan. I'm curious, can you explain why it's important that FOMC deliberations remain confidential and kind of the pains maybe that FOMC goes to keep those deliberations confidential?
So I am going to go and I've done different orders. So
Yeah,
I'll start
go
with
with
you.
that,
And, so again, these are obviously my views in terms of how to think about things. So one thing that I would say is that there is a transcript of every FOMC meeting, literally transcript. So word for word, what is said in that room. And those are made public, but with a lag, and it's a 5-year lag. And once they come out, they are scrutinized and read carefully. I think the shift over time to more transparency of monetary policy making has been very valuable. At the same time, I also think that in order, and we were talking about this based on an earlier question, what's it like around that table? I think in order to really hear, understand, vet different views, and then make a combined decision, I think that seeing all of that detail in the moment as markets respond and as we try to communicate what we're doing and why, I think it would really complicate the challenge, in my view, of communicating clearly why we landed, right? So my view is informed by what I hear around the table, and I can be very clear about here's why I believe this, but I don't know that the sausage of my thinking is necessarily something that should be out the moment that the Fed announces the policy. So I do think that a little separation there, in my view, is healthy. I'll also say there's a real desire, which I totally understand, and unfortunately, it's not something that we can do. There's a real desire to have a very clear path. What are you going to do, and what's going to happen each time? And so because we are almost never on a preset path, there have been a few times, for example, the depths of the Great Recession, it was clear rates were going to be at zero for a long time, and really explaining that clearly was super important. But almost never in other time periods do you set out a clear path. And there's a real hunger for that. And so having as clear a message as possible, I think, is super important for financial markets, for people's understanding, and for planning. And so I think the balance of releasing the transcripts with a lag and having a statement, having people like me talking about, our view and why we do things, having the chair in the press conference right after I think that's a good balance, and we'll have to see how, what the appropriate level of transparency evolves. So maybe that was a longer answer, but I think it's an important question. So let's see, your question.
International.
The international, yeah. So as an international economist, something that I care deeply about. So what I'll say is that, you're absolutely right that the U.S. monetary policy has global implications, and there are significant linkages among countries. That is something that we absolutely pay attention to. There are many joint meetings, there are many conferences, there's lots of discussion. At the same time, our charge from Congress is U.S. price stability and maximum employment. And so we're very aware of what we're charged to do at the same time that we collaborate and work closely, I would say, with other institutions. The BIS, the Bank for International Settlements, which is kind of the bank for central banks, is one of the organizations which is also charged with trying to help understand things more holistically. And so there's a lot of work behind the scenes that brings central bankers together. And I think that's really important. So the other one was Oh, and the politics. Yeah. So
So simple to close on.
I know each of these is like, one sentence answers. So, there is plenty to focus on related to a vibrant economy and the range of the portfolio that the Boston Fed has as we look across the first district. And so I have so much to think about that honestly, when I'm focused on how we accomplish our job, I do think of the political things as over there, right? Our job is to focus on that analysis, and we do it in a breadth of different ways, both the data analysis, the conversations, the all of it working together. So I think it's an important question to ask. I think the nonpartisan, non-political nature of the Federal Reserve is just essential. And, you kind of put that mindset on, and that's what we're focused on. And again, it's plenty to keep you busy 24/7. But again, I do think it's important for us to continue to be very clear about that, because the mission is public service for our economy and all of the people that our economy, it's about the people. It really is. And so that's what my focus is.
Susan, our mission at Tuck is developing wise, decisive leaders who better the world through business. You are in spirit a Tucky, I will say. Just thank you for serving our country as you are these days as President and CEO of the Federal Reserve Bank of Boston. This has been awesome.
This has been a pleasure.
Thank you.
For having me.